Good morning, everyone. We're going to give everybody about another minute to get started. We want to get started right at noon. So just giving everyone a few minutes to log on. Thank you. Good afternoon, everyone. Thank you for joining us today for our first webinar, 2024 webinar. Today, we will be talking about important federal student loan updates. So let me start with some housekeeping items before we get going. Throughout the entire webinar, your video, microphone, and chat feature will be disabled. You can enter questions in the Q&A function, but please hold off on your questions until we cover that topic. And I would suggest not asking detailed personal questions since this is a public forum. Today we will not be talking about specific programs, but we will an overview. This event is being recorded and it will be available to you on our YouTube channel within the next few days. My name is Celina Damian, and I am the Student Loan Servicing Ombudsperson with the DFPI. It is my pleasure to be here today with Betsy Mayotte, who is the president and founder of the Institute of Student Loan Advisors, or TISLA. She has been working in the student loan industry for over 20 years and has helped thousands of borrowers with their student loans and student loan issues. As I said, this is our first 2024 webinar, and I'm glad to be here today because there are many updates and deadlines to know about to help you manage your debt and get back on track. Today, we will be giving you an overview of the most important deadlines, but for those of you that want more detailed information on each program, PSLF, the IDR adjustment, your rights, you can log on to our YouTube channel, and there you will find our series of webinars from last year where we discuss each program in depth. Also, please keep in mind that each borrower's situation is unique and some of these programs may not apply to you, but we want you to start understanding your options and then to know that we are there to help. Next slide, please. So about the DFPI, we are California's Consumer Protection Agency, the Department of Financial Protection and Innovation, and we regulate companies of financial products to ensure compliance, and this includes student loan servicers. We accept and we evaluate consumer complaints against servicers, and we take enforcement and legal action when companies are not in compliance. We conduct education and outreach such as this one to enhance consumer awareness and to protect consumers from fraud and abuse. Next, please. TISLA is a nonprofit organization that offers free expert unbiased student loan advice and dispute resolution to all customers. And then there is their website. Next, please. And we will be including it also at the end of the webinar in our resources slide. So how much student loan debt do we have in California? So we have about 4 million borrowers that owe approximately $141 billion of student loan debt. Most of that is federal student loan debt. The average debt load of a California borrower is $37,000, and the average monthly payment is $203, although that may be changing soon with the new programs and the new SAVE plan. The majority of debt is held by borrowers between ages of 35 and 49 years old, and the default rate in California, although not the highest, is at 7%. Borrowers who attend for-profit institutions have higher debt amount and make less progress in paying the debt down. In the United States, borrowers owe $1.78 trillion of student loan debt, and this is the second highest consumer debt category behind mortgages. After adjusting for inflation, the nationwide federal student loan debt has increased sevenfold from 1995 to 2017. Next, please. In California, in addition to the protections offered for borrowers through the Higher Education Act, we also have something called the California Student Borrower Bill of Rights, which is really important for borrowers to know of, that they have this protection. And it basically prohibits servicers, student loan servicers, from engaging in abusive, unfair, or deceptive practices, and it requires that they work in the best financial interest of borrowers. It requires servicers to provide borrowers with information, accurate information, and timely information, and applications for income-driven repayment plans and other forms of for federal benefits and protections. So if you're contacting your student loan servicer to inquire about an IDR plan, to inquire about PSLF applications, TPD applications, or any application for a federal forgiveness plan, they should be able to provide you accurate information and provide you those applications. It establishes special protections for military borrowers, those working in public service, older borrowers, and borrowers with disabilities. So they have to train their staff to specifically help those borrowers. And then it protects borrowers from any negative consequences stemming from a sale, assignment, transfer, system conversion, or payment made by the borrower. So basically, if there is a servicer transfer, if there is a system conversion, if they change their platforms, you, the borrower, should not be incurring any harm because of that. So that is really important, especially now with all the changes going on, with all the transfers that happened prior to repayment restart. And then under the Bill of Rights, a borrower has the right to take legal action against their servicer if the servicer fails to comply with these laws. This is called the private right of action. And a borrower can file a complaint with us through the DFPI, or you can contact me to find out if your issue is something that you can file a complaint for. I can help you with that as well. Next, please. So the Borrower Bill of Rights specifies servicers, and real quick before we get into all our updates, I want to give you a quick overview of the difference between a lender and a servicer, because we get that question a lot. So for federal student loans, your lender is the Department of Education. So it's the company or the organization lending you the money. They originate the loan. The servicer is the company that Department of Education contracts with to manage your loan. So this is going to be the borrower's main point of contact. These are your 4 federal servicers. This is a company that tracks your loans while you are in school. It sends you your bill every month. It collects and processes your loan payments, processes changes in repayment plans. So essentially, every time that you are calling about your bill, about your payment, about any of the plans, you are speaking with one of these servicers. You may be transferred to several servicers throughout the life of the loan. And if you have more than one loan, you may have more than one servicer. So that's really important to know. You can confirm your student loan servicer on the studentaid.gov page, and there's a link here as well as a link on our resources page. But it's very important that you understand who your servicer is and who you're working with. Next, please. Return to repayment. So we know under the CARES Act in March of 2020, there was a pause to federal student loan payments. Interest rates were set to 0%, and student loan payments resumed October 1st of 2023, with interest resuming the month prior, September 1st, 2023. Prior to repayment, ED instituted a 12-month on-ramp program from October 1st, 2023 to September 30, 2024. So we are currently in that on-ramp period. So borrowers who missed a payment, made partial or late payments will not incur negative credit reporting, default, or loans being sent to collection agencies. So essentially, it's like a bumper. They give you a 1-year period to get yourself back on track. December of 2023, ED reported that only 60% of the 22 million borrowers with payments due actually got back into repayment by mid-November. So that means that a lot of borrowers are still not back in repayment. So some of those factors could be because there's been delays in IDR processing by the servicers, inconsistent payment amounts, delays in processing forgiveness, or just confusion with your options. So that's why today, I'm glad you're here today so that we can go over some of those options for you and help you get back on track before this September or this October 1st 2024 dateline, which after that period, then borrowers will basically be incurring any negative consequences if payments are not made. So next slide, please. And now I will hand it over to Betsy.
Thanks, Celina. I am not going to turn my camera on. My face will contribute nothing to this presentation. So just listen to the sound of my voice. All right, so let's start off by talking about the different types of federal student loans, because all the programs we're talking about today are exclusive to the federal student loan program. They do not apply to private loans. So under the umbrella of a federal student loan, you have there's 2.5 federal student loan programs. The most common one these days are direct loans. Now, a direct loan can be a subsidized or unsubsidized Stafford. It can be a graduate plus loan. It can be a parent plus loan. It can also be a consolidation loan. There's also the older loan program called the Federal Family Education Loan Program, or the FFEL. If you took your loans out after July 1st of 2010, and it's either a Stafford loan, a plus loan, or a consolidation, then it's absolutely a direct loan. If you took your loan out before July 1st, 2010, it could actually either be a FFEL or a direct loan. The FFEL program was the primary federal student loan program up until the summer of 2010, and then Congress got rid of it. After that, all Stafford plus and consolidation loans were direct loans. Now, if you did take loans out prior to 2010 and you're not sure whether you have a FFEL or direct, there's a couple different ways you can find out. The easiest way is to call your servicer and ask them. But these days there tend to be long phone queues. So if you log on to your servicer account, most of them actually have FFEL or DL in front of the loan type that will help you understand whether you have a direct loan or a FFEL. And then the last common federal student loan program I want to mention is the Perkins Loan Program. That also was discontinued in 2017. But there's still tens of thousands or hundreds of thousands of borrowers that still have Perkins loans. It's important for you to know what kind of loan you have, whether you have a loan under the direct loan program, a loan under the FFEL program, or a Perkins loan, because a lot of the waivers and the newer programs that we're talking about only apply to direct loans. Now, the good news is that if you do have a FFEL or a Perkins, you can consolidate that into the direct loan program and make it eligible for the different programs and waivers that we're going to be talking about in a few minutes. So again, just to recap, direct loans can be Stafford loans, graduate plus, parent plus, or a consolidation. FFEL loans can be a Stafford loan, a parent plus, a graduate plus, or a consolidation. Perkins loans are Perkins loans. There's no such thing as a consolidated Perkins. There's no such thing as a parent Perkins. It's just Perkins. But again, if you have FFEL or Perkins loans, as you'll see in a little bit, it might be a good idea to consider consolidating them into the direct loan program pretty quickly. Next slide, please. All right, so under the federal student loan programs, there's essentially two different buckets of repayment plans. There's a bucket of repayment plans where your monthly payment amount is based entirely off of whatever your balance is. Doesn't matter what your income is, doesn't matter where you work, doesn't matter what state you're in, what your monthly payment is going to be based off your balance. The other bucket of repayment plans are those that are based on your income. Now, the umbrella term we use for those plans are income-driven repayment plans, or IDR. So if you hear Celina or I using the term IDR, we're talking about that bucket of plans that's based on your income and your family size and the state you live in. So to put it in perspective, if you have two borrowers A and B, and they both owe $50,000 in federal student loans. One has an income of $50,000 a year, and one has an income of $100,000 a year. If both of those borrowers are on a payment plan that's based on the balance, so the ones that you're seeing in the left-hand column, they're going to have the same exact payment as each other because they both owe $50,000 in loans. But if they're on payment plans that are based on an IDR plan, or the right-hand column that you see in front of you, they're going to have different monthly payment amounts because they have different incomes and family sizes. So just a super quick overview of these plans. We don't have time to go into the gory detail. I do strongly suggest that you read up on all of these plans, which you can do at the studentaid.gov site. The other thing on the studentaid.gov site is there's a really neat tool called the Loan Simulator tool. And all you need to do is plug in your information once, and it will tell you what your monthly payment amount is going to be under all the plans you're potentially eligible for. More importantly, it's going to tell you, if you were to get on that plan and stay on that plan, how much it would cost you out of pocket over time. And that's the name of the game, my friends. We talk a lot about loan forgiveness, and man, those programs are important and they benefit a lot of people. But people sometimes get caught up in the word forgiveness, and that's not the goal. The goal is to pay the least amount out of your own pocket over time. And for some people, that's going to mean pursuing a forgiveness program. For other people, that's going to mean maybe paying their loans off more aggressively to save in interest costs. Anyway, quick overview of these plans. Under the balance-based bucket, we have the 10-year standard plan. Now, that's the plan you're going to get put on when you leave school if you don't actively apply for a different plan. It also tends to be the one that is the cheapest on the long term. So they're going to figure out what payment you need to make, where if you made that payment every month for 120 months, which is 10 years, that you would end up paying the balance off. The extended repayment plan is sort of the same thing, but they're extending the term from 10 years to 25. And that's only for people who owe at least 30 grand in loans. So again, you're going to have the same monthly payment every month. They'll figure out what payment you need to make every month to pay it off in the 25 years. The graduated repayment plan is one of the oldest lower payment options under the federal student loan program. It's sort of self-explanatory in that your payment starts off low and then gradually increases over time. You're still going to pay it off within the 10 years, but your first 2 or 4 years under that plan are going to be interest-only payments. And then again, years after that, the payment will gradually go up. Graduated extended is kind of a mishmash of the 2 previous ones I talked about. You're going to make interest-only payments for the first few years, but they're going to extend the term to 25 years and give you a payment. The payment will gradually go up over time, and they'll set it up in such a way that you will end up paying it off within the 25 years. Now, for all of these plans, you can always pay more than what's on your bill. There is never, ever, ever a penalty for paying extra on your loans. You also can change plans at any time. If you decide that, the graduated extended plan is the right plan for you right now, then apply for it. If 2 years from now you think that an income-driven plan is better for you, you can apply for an income-driven plan at that point. There's no penalty for changing plans for the most part. All right, so under the IDR bucket of plans, we've got 5 of them, and they're all exactly the same except where they're different. We have old IBR, which is the only income-driven plan that is an eligible plan for FFEL loans as well as direct loans. Now, all the payment plans I talked about on the left-hand side, any FFEL loan, any direct loan can get it, whether it's a consolidation or a Stafford loan or a Grad Plus or a Parent Plus. Old IBR, any FFEL or direct loan can get it except for a Parent Plus loan or a consolidation loan that includes a Parent Plus loan. Parent Plus loans with 2 exceptions are generally not eligible for the income-driven plans, and I'm going to talk about those exceptions in a minute. New IBR is for direct loans only, again, not Parent Plus loans and not consolidations that have Parent Plus loans. But new IBR is only for borrowers who took all their loans out after July 1st, 2014. The pay-as-you-earn plan is actually very, very similar. It's sort of a fraternal twin to new IBR. Again, it's only for direct loans, no Parent Plus, no Consolidated Parent Plus, and it's only for borrowers who took all their loans out after October of 07, and they have at least one disbursement on a loan after October of 2011. ICR, or income contingent, is again only direct loans. Now this one a Parent Plus loan can get to, but only if they consolidate those Parent Plus loans. At that point, they have access to income contingent and income contingent only. And then finally, the sort of most well-known plan right now is also the newest, which is the SAVE plan. The SAVE plan used to be called Repay. Any direct loan other than a Parent Plus loan or a consolidated Parent Plus loan can have access to SAVE. Now, all of these income-driven plans have some things in common. And if we go to the next slide, I believe we're covering those next. Yeah. All right. So as I mentioned, non-income-based plans are set up so you pay the loan off within a certain period. There's absolutely no forgiveness components to these plans. Now, all the income-driven plans do, one of the things they have in common, in addition to they all base the payment off of your income, they all have a forgiveness component baked into it. So if you're on the plan or on a combination of the plans, you don't have to, the plans sort of mix and match with each other. You don't have to stay on the same IDR plan the whole time. But if you're on the plan for either 20 or 25 years, and under the SAVE plan, it might actually even be 10 years, they're going to forgive whatever's left at the end of that 20, 25 years. Now, the forgiveness timeline depends on what kind of loan you have and the payment plan you're on. So, for example, if you have any loans from grad school, if you're on pay-as-you-earn or new IBR, your forgiveness timeline is going to be 20 years. But if you're on the SAVE plan, or ICR, your forgiveness timeline is going to be 25 years. You do have to, with the exception of a waiver that we're going to talk about in a few minutes, you do actually have to be on any of the income-driven plans or the 10-year standard plan for the payment to count for the 20 or 25 years you need for forgiveness. So that for 20 years, you'd need 240 payments under the plan. For 25 years, you'd need 300 payments. Now, you can, as I mentioned, you can change plans at any time, and doing so doesn't mean that you're going to restart your 20-25 year count. The other thing you need to know is that unless Congress takes some action, if your loan is forgiven, if the balance of your loan is forgiven after 2025, that forgiveness amount will be taxed as income. Now, some people freak out when they hear this. If they estimate that they're going to get 80 grand forgiven, they're saying, I can't pay an $80,000 tax bill. Well, you don't have to, because they tax it as income. So whatever tax bracket you're in, and then whatever other deductions or credits you get, that's going to be baked into the tax formula. And if you have, the IRS does have payment plans. They even have ways to wipe out a tax bill if the consumer has very little income or assets. So don't freak out about the so-called tax bomb. Next slide.
Yeah, I'll take over.
Okay.
Yeah, now, so thank you, Betsy. That was awesome. Great overview of all the plans and loans. So I want to take a few slides or some time to talk about specifically the SAVE plan, because we have heard so much about it. And we have a lot of borrowers that would really benefit from getting on this plan. So in 2023, Ed rolled out this plan. And as Betsy mentioned, it replaced the repay plan. So SAVE is one of the IDR plans, and it falls under that bucket. So borrowers that were on the repay plan, they were automatically switched over. There was no action required. So when they got back into repayment, they were automatically on this new plan, and they may see lower payments under this plan. So as you can see, the loans that are eligible The ones that were mentioned, all the direct loans, direct plus loans, except parent plus loans, and direct consolidation loans that did not pay a parent plus loans. There are those FEL loans, those Perkins loans that can benefit or can qualify if they consolidate. So that's why it's so important to understand what type of loan you have and if you need to consolidate. So if you have direct loans right now, a mix of loans and they're all direct plus loans, then you would automatically qualify. Then there are those that are ineligible, direct plus loans made to parents, direct consolidations loans that repaid, plus loans made to parents, FEL program loans, and then federal Perkins loans can become eligible again if consolidated the FEL and the Perkins. And then any loans that are currently in default, but we will talk about that, an option for those borrowers that are in default at the end of the presentation or at latter part. Next, please. So some of the current SAVE benefits, these were implemented immediately. So a borrower can benefit from a lower monthly payment. So what the SAVE plan did is that it decreased the monthly payments by increasing the income exemption, basically protecting more of your income from 150% to 225% of the poverty line. So single borrowers earning $32,800 or less and families of 4 earning $67,500 or less will have $0 monthly payments. And there are millions of borrowers currently that have $0 monthly payments. And it's important to understand that even though you're making, excuse me, even though you are at $0 payment, these payments do count towards PSLF forgiveness and towards IDR forgiveness. So as long as you are in repayment status, and even if you have a $0 monthly payments, it is being counted towards forgiveness. One of the really important benefits of the SAVE plan, this IDR plan, is the interest subsidy portion of this. So what this does, it eliminates 100% of remaining monthly interest for both subsidized and unsubsidized loan after you make the full scheduled payment. So sometimes borrowers get confused because they are still seeing interest being billed or interest in their bills, basically. So under the other IDR plans, what happens is if you make a payment, for example, let's say your payment is $20 a month, but the interest that's accruing monthly is $50. If your payment of $20 didn't cover that $50 interest, the additional amount was being capitalized or added to your total balance, therefore increasing your total loan balance. So under SAVE plan, that $30 is being subsidized or covered by the government, and you won't see your balance growing. So even if you have a $0 payment and your interest is any amount above zero, which it most likely will be, it's not going to be added onto your balance. So that's going to help borrowers greatly make those payments, pay down those loans, or just not seeing their balances increase. Again, it eliminates interest capitalization. So when you switch from one IDR plan, your unpaid interest won't be added unless you're switching from an IBR plan. And then there's a spousal income exclusion. So it excludes spousal income for borrowers. Excuse me, 1 second. Excuse me, it excludes spousal income for borrowers who are married and file taxes separately. It also removes the need for a spouse to co-sign your IDR application, resulting in a simpler process. Next, please. So these are current benefits. Next, please. Starting in July of 2024, there's additional benefits that are being rolled out. Payments on undergraduate loans will be cut in half, so reduced from 10% to 5% of income above to 25% of the poverty line. So if you are currently on SAVE and you're paying on your undergrad loans, you will see your payment decrease even more. Borrowers who have a mix of undergrad and grad loans will pay a weighted average between 5 and 10% of their income based on the original principal balances of their loans taken to attend school. And then consolidation, starting July of 2024, borrowers who consolidate into a direct consolidation loan will receive credit for a weighted average of payments that count towards forgiveness of the loans being consolidated. So they won't lose all the credit from previous repayments. And then there's an automatic enrollment after missed payment. So borrowers who are 75 days or more late with their monthly payment will be automatically enrolled in an IDR plan if they have agreed to allow Ed to securely access their tax information. And then Ed will enroll the borrower on whichever IDR plan the borrower is eligible for that gives them the lowest monthly payment. So if you are, this avoids borrowers from going automatically into delinquency and default, especially borrowers that already have that information being pulled from the IRS. Next, please. And then another update or another forgiveness that you may have heard about in the news. Recently, there was a early loan forgiveness. So Betsy talked about the IDR plans having a forgiveness component. And most of those were, well, all of those were either 20 or 25 years. Under the SAVE plan, it was announced that borrowers would be eligible for early loan forgiveness for after a repayment term of 10 years or 120 monthly payments. So for repayment term is the amount of time you need to have spent in repayment and is based on your total original principal balance you borrowed on the loans that are still outstanding. So under the SAVE plan, if you individuals who borrowed $12,000 or less and have a repayment term of 10 years or 120 monthly payments, they will be automatically eligible for forgiveness. So you do have to be under the SAVE plan. You could have previously been on any IDR plan, and then you had to have that balance of $12,000 or less. So that was the first round of forgiveness that just happened in February. So your repayment term increases for every $1,000 borrowed above this amount. And then after a certain time, I believe it's 18 or 19,000, then you fall back into the 20 or 25-year window. The repayment term cap is different depending on whether you have only undergrad loans, that would be 20 years, or a mix of graduate and undergrad loans, and then graduate loans for 25 years. So how do you find your payment history to determine repayment, forbearance, deferment periods? You should be able to obtain that through your servicer. Every time there's a loan transfer, whether you've been paying for 20 years, 30 years, 10 years, your servicer should have that account history. So for those of you that want to track and see where you're at, for IDR forgiveness, right now there is no way of, there's not a tracker similar to the PSLF tracker. So you're not able to go in and see exactly where you're at. But for those of you that want to take the time to go in and pull your history and actually give your estimate where you are, you should be able to get that from your servicer. And then they should have a history of all your payment. If you go in and you find that they only have your history up until maybe a few years back, which we are seeing some issues with that, where we are seeing some gaps in history, you can file a complaint and submit that request in writing for them to pull all your payment history. So many borrowers are doing that because they want to find out what the best strategy is. If they stay on SAVE, should they move to another plan? If SAVE is the best for them. So you can find your payment history, all those. You can also go on studentaid.gov, although it doesn't have a detailed monthly payment history. It does have, you can pull up detailed history there, and it will show you if you went from forbearance to deferment, maybe back to repayment. So it won't show the month specifically, but you should be able to pull some history from there as well. And it's very important. I always tell borrowers, keep your history, download all your account history just in general. That way you have it for your own records in case there are any transfers and there are mistakes made during the transfers or gaps during the transfer. Next, please.
Actually, can I add some clarity?
Yeah, well, it's your turn anyway, so go ahead.
Oh, good. Can we back up a slide real quick? Celina did a really, really good job explaining all these. And the only reason I'm stepping in is because at least here at TSLA, some of these things are things we get thousands of questions about. So I just wanted to add some additional clarity. For the $12,000 forgiveness, as Celina very clear stated very well, it's based on if the total amount you borrowed was $12,000 or less. So we get a lot of questions like, what if I pay some of my loans off and now I'm below $12,000? Does this apply to me? The answer is no. What if I pay some of my loans down and now I'm less than 12,000 and then I consolidate so it's a new loan that's less than 12,000? Does this apply to me? The answer is no. So it has to be, the only way the 10-year would apply to you is if the total amount you borrowed was $12,000 or less in the first place. The other thing I wanted to add is, although it's not pretty, but your servicer should have your loan history. However, if you consolidated, your consolidation servicer probably is not going to have your loan history because those loans are gone. Those loans were paid off by the consolidation. So they'll have the history for your current consolidation loan, but they're not going to have the history prior to that. Also, if you switch servicers, it can be a little more difficult, even if you don't consolidate. If you switch servicers, it can be a little more difficult to access the history. So, pro tip, life hack, but again, it's not pretty. If you log into studentaid.gov and go into loan details, there's a TXT file. And that's going to give you the loan history on all your loans back to the beginning of time. But it is not written in a consumer-friendly way. It's decipherable. You don't need to be bilingual to read it, but you need to have patience. And it's not set up in a pretty way. So you can get access to your full loan history that way. It's just, again, not as easy as we might like it. Next slide, please. Okay, so we talked about the forgiveness component that's baked into the IDR plans. And we've said, because it's true, that you actually have to be on an IDR plan or the 10-year standard to get credit for those 240 or 300 payments. However, there's this one-time waiver in place that the Biden administration is doing. And essentially what they're doing is, and this is one time only, it will never happen again, is that for all direct loans, they're going to give borrowers credit for every month that they were in an eligible status, whether it be, so that eligible status means any repayment plan, IDR plan or not. They're giving credit for some deferments. They're giving credit for some forbearances towards the forgiveness months needed under the IDR plan. So let's say you've been on the extended repayment plan for the last 15 years. Under the one-time account adjustment, they're all of a sudden going to give you credit of 15 years towards the 20 or 25 you need for forgiveness under the income-driven plans. Now, there's no application for this. If you have a direct loan or a loan held by the Department of Education, it's just going to happen. But there's also no way to see where you are in the queue. They've got 40 million accounts to adjust. Now, they've already started. They started back in August. They're doing them in batches around every 2 months. There is not a single person on the planet that you can call or complain to get your account adjustment done any faster or find out where you are in the queue. The Department of Ed has said that they do hope to finish all the adjustments by this fall. So it's a matter of, as I like to say, putting your patience pants on. Now, once you get the adjustment, you will see a count on your account. And if the adjustment means that you all of a sudden are qualified for forgiveness because you've hit the 20 or 25 years, they will automatically process that forgiveness. Again, there's no application required. If you have a direct loan, then they're automatically going to do it. But if you don't have a direct loan, if you have FFEL or Perkins, it's urgent that you consolidate before April 30th, 2024, that you consolidate those FFEL or Perkins loans into the direct loan program, which again, you do at studentaid.gov. If you do it by April 30th, then they will include you in the one-time account adjustment. They'll also give you credit for periods of repayment and other eligible periods on that FFEL loan. The other benefit, if you have loans that have been in repayment for different periods. So the most common example is you went to undergraduate school, took out a bunch of loans, you finished undergrad, you worked for a little while, made payments, then you went to grad school, took out more loans, and now today you have undergraduate loans that have been in repayment for, say, 36 months, and you have graduate loans that have been in repayment for, say, 5 months. If you consolidate before April 30th, when they do the one-time account adjustment on your account, that consolidation is going to get credit for the 36 months. It's going to get credit for the higher count of those underlying loans. So just to be clear, when you initially consolidate, it's going to reset you to 0, but don't freak out. Once they do the one-time account adjustment, which again will be sometime between now and the fall, then you will end up getting that higher count. And again, you'll get credit for those FFEL loans. Now, when I say you have to consolidate by April 30th, I don't mean the consolidation has to be done. I just mean that you have to have submitted a completed consolidation application by April 30th to get these extra benefits under the IDR adjustment. Now, listen, most people are not going to have to consolidate. Most people, all their loans have been in repayment for the same amount of time. Most people already have all direct loans. And if that's you, there's no benefit to you consolidating. It's only people that have those sort of weird one-offs that they really could benefit by consolidation. If you're not sure, if you go to TSLA's website and go to our consolidation page, there's an infographic decision tree right at the top that will help you figure out if consolidation is something that you should be doing by April 30th or not. Next slide, please. Okay, so to give you an example of the adjustment, I have 2 examples here. First example is someone that has a direct consolidation loan. In that, under that direct consolidation loan, they have $50,000 in undergraduate loans that had been in repayment for 27 months prior to consolidation. And they also had 80 grand of graduate loans that had been in repayment for 3 months. Under that, if they submit their consolidation application by April 30th, the new direct consolidation will be given credit for 27 months. For direct loans that are not on an income-driven plan, this is another example. Borrower's been in repayment for 264 months, 22 years. They've only been on an income-driven plan for 32 of those months. Once the one-time IDR adjustment is done on their account, they'll be given credit towards forgiveness, towards the IDR forgiveness for the 264 months. So they'll be 22 years in to the forgiveness needed under the some of the IDR plans. And if all they had was undergraduate loans, in that scenario, they'd get immediate forgiveness. Next slide, please. Okay, so just to recap, for people that submit a consolidation application before April 30th, they're going to end up getting the higher count of whatever the underlying loan counts were, and that's both towards public service loan forgiveness as well as the IDR forgiveness. They're also going to count periods of FFEL repayment. People that consolidate after April 30th, but before July of 2024, run the risk of not getting any of those benefits. So if for some reason you can't or don't want to submit a consolidation application by April 30th, you might want to wait to consolidate until after July. So at least you can get credit for the weighted average of, as Celina mentioned, they'll be doing a weighted average of the credits of the underlying loans. Technically, that weighted average was effective last year, last July, but because of this waiver, it's been pushed out. And as of right now, the Department of Education is saying that weighted average won't be in place until July of 2024. Next slide, please. Some other important changes. After the end of the IDR adjustment, you must be on an IDR or 10-year standard plan to accrue eligible PSLF credits. So the example I gave you a few minutes ago, where under the IDR adjustment, someone who had been in repayment for 264 months, but had only been on an IDR plan for 32 months, once the adjustment's done, they'll have credit for the 264. They will have to be on an IDR plan to accrue the rest they need to get to the 300 payments needed for forgiveness. Couple other things that are changing. They're sunsetting some of those older IDR plans. So for pay as you earn, if you're not actively on the pay as you earn plan on July 1st, 2024, then you can never get on pay as you earn. And if you've been on it before and get off it, you can't get back on it. If you've been utilizing repay/save for at least 60 months, as of July 1st, 2024, you will also no longer have access to quote unquote new IBR. And if you're not actively on income contingent and you don't have Parent Plus loans, you will never be able to get on ICR or get back on it if you leave. Now, the reason they're doing that is because that some of these plans have a shorter forgiveness component. And so they're sort of trying to eliminate a loophole where someone can be on a payment plan that has a lower monthly payment for a while and at the last minute switch over to one that has a shorter forgiveness component. So that's why they're also trying to make things simpler. So if there's less options, there's sort of less confusion. Next slide. Celina, were you covering this part or was I covering this part?
You were covering.
Okay. This is a more recent update. So as part of the on-ramp period that Celina mentioned at the beginning of the presentation, normally with an income-driven plan, you are required to recertify your income every year. And if you don't do it by the deadline, your payment can go up, they can kick you out of the plan. The consequences sort of depend on which plan it is. Now, part of the on-ramp period, they weren't requiring anybody to recertify their plan before March of this year, but there's been some issues on the servicer side. So they've actually just recently, just about a week ago, they announced that they're extending that recertification pause. So now nobody is going to have to recertify their income unless they want to before November. If they did recertify already and it made their payment go up, the services are going to automatically switch their payment back to what the lower payment used to be. If somebody already recertified and their payment went down or stayed the same, they're not going to take any action. Now, one thing to know that, let's say your IDR anniversary date is, November 15th. You're going to be required to submit your recertification paperwork well before that. And the reason is because the servicers need time to process it. So your recertification paperwork is going to be due at least 35 days prior to your actual recertification/anniversary date. And you're going to start receiving notification about it as much as 3 months before that deadline to submit the paperwork happens. Now, if the servicer doesn't receive the paperwork until after 10 days prior to your actual anniversary date, then you will get the consequences of being late. You will potentially get kicked out of your plan or be put and be put on essentially a 10-year standard payment amount. Next slide. Okay, so the last thing I wanted to mention to you today, a couple people have asked about Parent Plus, and when I was talking about the IDR plans, I mentioned that with the exception of ICR, Parent Plus loans are consolidated. Parent Plus loans don't have access to any of the IDR plans. Well, there is a loophole, and I'm going to be the first one to tell you it's complicated, but sometimes loopholes are. And unfortunately, we don't have time to go into the gory details for it, but essentially, if you can consolidate a Parent Plus loan twice, then that double consolidated Parent Plus loan will then have access to the SAVE plan. Now, we have detailed step-by-step instructions on our website at the bottom of the consolidation page. I strongly urge you to read every word of that explanation and follow it to the letter. But it does work, and it's legal. It's written in the regulations. But that loophole is closing, whereas anybody who has not double consolidated, and that means completed double consolidation by July 1st of 2025, will not be able to get the benefits of a double consolidation. Celina. On to you.
Thank you. Next slide, please. So I will briefly cover some PSLF updates. I'm not getting into the requirements, things like that, but some things that I want you to remember about PSLF. Mohila is your student loan servicer. All the months of the payment pause or the forbearance months count towards your PSLF count. So that's March of 2020 through September 30th of 2023. PSLF is non-taxable under federal and state law. And if you are new to public service, I would suggest you start tracking your progress or start or apply even within your first year. Next slide, please. And Betsy, can you mute your mic, please? Thank you. Some of the updates for PSLF. So if you missed the waiver, you're still employed with the qualifying employer. All the consolidation that we've been talking about today, the date of April 30th, 2024, it also applies to borrowers that are on PSLF track. So what you have to understand is that there's different, you can be on the IDR forgiveness track, you can be on the PSLF forgiveness track. So those Fell and Perkins loans, those older loans can get on track to those programs, but you need to consolidate. So you won't lose credit. The consolidation information we've been talking about also applies to PSLF updates, to PSLF. So someone asked how the IDR adjustment affects PSLF. It actually would help you. So if you are on the PSLF track, you have some periods of forbearance and deferment, maybe a year or two. What the IDR adjustment is going to do, it's going to fill in those gaps. So they're going in and giving borrowers credit. So not only will you increase your count for towards IDR forgiveness, but also towards PSLF. So you may only be looking at your repayment months and think you're maybe at 100, but then they go in and they do an adjustment on a review on your account, and your count may increase. There is a new digital signature process where you can just email your employer directly. The SAVE plan is an eligible plan for PSLF. It is one of the IDR plans. So you can be on the SAVE plan and continue being on the PSLF track. Ed announced a PSLF buyback program. That's for borrowers that are close to the 120 and buying back some of those forbearance deferment months will put you at 120. So that's for borrowers that are close to the 120, maybe no longer in public service and just need those few months for the 120. Your loan servicer, after repayment restart, your loan servicer may have notified you that you were placed on administrative forbearance. That was per Ed guidance. So just know that any interest that accrued during that forbearance period will be eventually removed, and that you will receive PSLF credit for the months that you were placed on forbearance, whether it was to put you on a SAVE plan, switch you to another plan, maybe update your account. Really important, Mohila will pause processing of all PSLF applications, new and recertifications, between April next month and June of 2024, as they are transferring their platform. So I would suggest you try to get in any certifications. If you're close to the 120, do it now, but if not, they are going to, so there will be a delay essentially. So you won't be seeing any updates until after July with everything going on. Again, really important that you take action as soon as possible to avoid further delay. Next, please. The Fresh Start program, this is a program for borrowers that are in default. So again, for a borrower that is in default, for you to get access to any of the IDR plans, including the SAVE plan, for you to get on the PSLF track or on the IDR forgiveness track, you have to be in repayment status. So one way that you can get out of default and into repayment is through this one-time program, the Fresh Start program. Under the Fresh Start program, if you opt in, you will not only have access to these programs, but you will receive restored your access to Title IV federal student aid, stop collection efforts or collection fees. Defaulted loans will be reported as current. So basically credit reporting will stop, and then, or negative credit reporting, and it will preserve the first date of your first delinquency. So for this program, it's not automatic. You do have to opt in. The process is very simple, but we do urge borrowers to opt into this program so that you can get yourself back on track. You have until September 30th of 2024. After October 1st, all garnishment collection actions will continue or will start up again. So again, a very important program for those that want to get access to the other programs. Next, please. And then one thing we must mention, we are the Consumer Protection Agency. With everything going on, all the confusion with all these programs, forgiveness on the news, scammers are really ramping up their efforts. And we are hearing from many, many borrowers who are receiving phone calls, texts, official looking letters offering them services to consolidate, offering them services for forgiveness, they're promising forgiveness. So that's why it is really important that you know the name of your student loan servicer. If you receive a letter and it's a company that sounds like student loan assistance, just something official, verify the information, Google the name of the company. Never give out your login information or passwords. That's your studentaid.gov information. They're going to request that. In some cases, they will have you sign power of attorneys for them to basically essentially do the same things that you can do for free. Do not sign anything. Do not subscribe to a monthly service or sign a contract. Know that all the information, you can have access to any messages, any letters that are sent out on your studentaid.gov site and on your servicer site. That's why it's really important to know who you should be dealing with or who's going to be contacting you. Just remember, there's nothing a company can do for you that you can't do on your own for free. We won't, loan servicers and the government in most cases will not be calling you on the phone. If someone is offering you special access or there's a sense of urgency that you're going to lose out or do it now, it may be a scam. So you can file a complaint with us if you have been a victim of fraud or with the FTC, and you can always email me, email one of us and say, hey, I received this letter. Is this legit? Just remember, look at the .gov.com. So student aid will usually have a .gov at the end. Any government agency will end in .gov, and anything else may not be legit. And actually the servicers are switching over to .gov as well within the next year or so. Next, please. And here is a slide with all our resources. So federal student aid has all the information about the IDR adjustment, the recertification extension, SAVE plan. There is our emails, and then of course you have the YouTube page. And then I don't see any questions in the Q&A, but is there anything that Betsy, that we'd like to add? I would urge anyone who really wants, like I said, a detailed information on PSLF, on the process, on the IDR adjustment, and our webinar series. We have an hour just dedicated to that, to just even borrowers in default and what to do in that case, what your options are, and then your rights and protections, both federal and state. So we have five of those webinars that we've done, just repayment options, because like I said, not everyone has the same, it's not the same for everyone. So let's,
yeah. Speaking of default, one thing I want to mention is periods of default do not count towards forgiveness in any scenario, including the one-time adjustment. So that's something to keep in mind. The other thing for PSLF, if you've never submitted proof of your PSLF eligible employment, it's a really good idea to get in the habit of doing that on an annual basis. And you absolutely, if you have PSLF eligible employment from 10 years ago, you can submit it now. And the best way to do it is by using the PSLF help tool, which I think you mentioned, which is also on studentaid.gov. And I just want to second what Celina said. The best way to manage your loans is to educate yourself about them. And thankfully, we're in the age of the internet. And studentaid.gov has a lot of great information. The DFPI website does, our website does, shameless plug. So read all the things and educate yourself about the different options that are available. Not knowing about an option and losing out on it, unfortunately, is not a defense. So you just want to make sure that you're not missing out on the best thing. And I want to remind people, the name of the game isn't forgiveness. I've seen some people pursue forgiveness in such a way because they just wanted to say that I had a couple grand forgiven on my loans, that they ended up paying more out of pocket to do it. So the name of the game is to cost yourself the least amount of money. And for many borrowers, especially if your income is a lot higher than your balance, unless you've been in repayment since the dinosaurs roamed, chances are the way for you to spend the least amount of money is to pay your loans off aggressively. But again, for other people, it does mean pursuing loan forgiveness.
Thank you, Betsy. And I'm answering a question right now. But again, any specific questions, you're not sure about some of the information and you don't understand these resources, sometimes you need to hear it once or twice, you can reach out to us and we can help you. It looks like I'm getting some additional questions. Just understand there are some delays. There are delays on PSLF certifications, on IDR application processing. So those patient plans are really important. If it's more than 90 days, you just haven't heard anything, 120 days, and I would suggest you reach out and then we can reach out to the servicers or help you understand what's going on. And it looks like we're at the 1 o'clock mark, but I want to thank everyone for joining us this afternoon. We will be planning additional webinars soon, but we are here to assist you and hopefully we helped you understand some of your options today. So thank you very much and have a great rest of your day, everyone.